Welcome to the Intermarket Analysis video update. This is a weekly video where I look at a number of different things that focus outside of the S&P 500. I do look at the S&P 500 on a valuation basis, but I look at growth versus value, and we're kind of dealing with that right now. So that should give some insight as to what's happening in the market. I also look at other markets outside of stocks just to see how they're doing because there's some inflation concerns that are on the horizon right now. Then I looked at all the different sectors and see how they're performing and what's looking strong, what's looking weak, what's looking just okay at this point. This is being prepared for Monday, March 3rd. First area is valuation. Now, if you've watched these videos before, we've been saying the same thing over and over and over again. Even though we've been running into some difficult times in 2025 with the upward momentum, the market is still overvalued. Now, this shows historical earnings that have already come out. It's old news, but still we can get some insight from this. And you can see the black line, that's the S&P 500, and it's well above the red dashed line, which is a PE ratio of 20. When we get 20 or above, the market's considered to be expensive. But you can see we've been this way for years now. And whenever we start to hit some trouble, whenever things kind of get a little bumpy, the the area of valuation comes up. But then things turn and go positive again, and that just seems to go away. I don't use this to make decisions. I just use this for informational purposes. So yeah, we are considered to be expensive. Down at the bottom, I break it out a little bit. This is the distance from the S&P to the red dashed line, and we're very, very high right now. We're considered overvalued. Now, some people use this as justification for a decline because one of two things have to happen or a combination. Price has to come back down to the red dashed line, or the red dashed line has to go up. That means earnings are going up, or price is coming down, or a combination of the two. But as I've said, this has gone on for quite a while. This also looks at it historically and where the market was at on a valuation basis going back to 1980. And we're very overvalued right now. Okay, that's historical though. Another way of looking at this in a historical way is called the Shiller PE ratio, where instead of just looking at earnings report after earnings report, this takes a more smooth approach where it looks at earnings over a 10-year period of time and averages them out to try to get something that's more realistic. Well, we're still coming in at 37.53. If you look at the median and the mean, we're between 16 and 17 here, so we're over double what the average has been over a period of time. This is a chart I started showing a couple weeks ago, actually, and it puts some standard deviation lines on here too. When we get above the +1 standard deviation, that means we're getting expensive. If we drop down to the -1 standard deviation, then we're getting inexpensive. And we've been up here for years now. And this chart doesn't change all that much, so I just keep showing it for the time being. It's looking about the same as it was a couple of weeks back when I first started showing this. Then the market, though, looks forward. What are the current forward-looking PE ratios? And they're coming down as the market's been coming down. This purple line is the mega cap 8. These are the real high-flying stocks. And even though it's coming down, we're still at 27. Now, even with this chart, we still use a 10, 15, 20 scale. So when we're above 20, we're still considered to be expensive. So even looking out, the mega cap 8 are expensive. Then the red line is the S&P 500. It's even over 20, even with the loss of momentum and the declines that we've been seeing lately. It's coming in at 21.5. Now, more in the fairly priced area, which is right around 15, we have the mid caps and the small caps, but they haven't been doing much. They were supposed to kick into gear last December with the Santa Claus rally and go through January and really see some strong momentum going into about March. Nah, that's not what they're doing right now. Some of this could be because of interest rates going up, because smaller companies, mid caps and small caps, they get hit harder with higher interest rates. And so the earnings just aren't there. And they have to borrow a lot of money just to keep going, where larger companies can usually absorb that a bit better. They're coming in with the mid caps at 15.6, where the small caps are at 15.3. So on a valuation basis, yeah, they look fairly priced right now. But if you look under the surface at some of these companies, are they really looking all that attractive? The market doesn't think so when we look at the indexes as a whole. All right, then we look at growth versus value. First of all, I look at just the growth index by itself. And this is in an uptrend, but it has been pulling back. We're watching this because there is a relationship between growth and value, and that's taking a bit of a hit right now. And part of the reason is that growth has been declining and value's been actually holding up. It's not really going up right now, but it's maintaining price above its 50-day moving average, and it's also in an uptrend. Where we do the analysis is looking at ratios between growth and value. On the top, we show that growth is outperforming value but pulling back. On the bottom is an inverse, and I do that because sometimes these crossovers that you see here, they might vary a little bit. We just want to see confirmation. Also, sometimes you might pick out something in the bottom chart that you may have missed in the upper chart. So that's why a number of the charts that I use have an inverse relationship showing. But value has been underperforming and it still is, but lately it's been bouncing back up, and that's causing some concern, wondering if the market is shifting and becoming more defensive. When the market is on offense, growth outperforms. When the market's on defense, value outperforms. And we're seeing that change a little bit, but it hasn't switched over yet. We just have to keep watching this and use other charts and use technical analysis to try to figure out where we're at right now and when the relationship actually shifts over and looks more long term. Right now, we've been through these types of things before and we've been able to recover from that. Now we look at growth versus value using a couple of ETFs going back to 2005. Growth is still outperforming, but pulling back. And you're going to see that going through the rest of these charts in this section. This shows where value's been underperforming, but bouncing back up. And we look at some indexes. Growth is in an uptrend compared to value, but pulling back again here. This shows where value's underperforming, but bouncing. But we haven't really changed any of these trends yet. And then this also shows how growth is outperforming, but pulling back. So we're seeing a lot of confirmation, looking at different time lengths, looking at indexes, looking at ETFs. So we try to get different perspectives on this relationship. And one that I show in the daily video, and this could be interesting. We look at a growth ETF and a value ETF and do a ratio. We're coming down to the 250 period moving average. Now, we've fallen below that before, only to recover. But we're at that point where we came right down to this black line, which is a 250 period moving average. And in Friday's session, we bounced up just a little bit. Now, we also saw the NASDAQ hit its 200-day moving average and bounce up off of that. And that's where the rest of the market got some support in Friday's session. Is that the beginning of something or just something that's going to happen in Friday's session and then in the upcoming week go back to looking more negative or with the market getting more defensive? These are the things that we watch day in and day out. And by we, I mean I. Okay. This also shows that same relationship where value is underperforming growth, but coming up to this moving average. Is that going to be resistance or are we going to keep breaking through to the upside with this relationship? We look at the small caps, which are still in an uptrend with their growth to value ratio, but really falling back underneath the 200-day moving average with this ratio. Mid caps also in an uptrend, but falling below their 50-day moving average. They haven't quite got down to their 200-day yet. The one that I focus on the most is the S&P. It's holding up okay, but it's been getting hit lately. Excuse me. If this continues to show weakness and we eventually get to the point where we're in a downtrend, that's when things are going to be more defensive. Excuse me. Gotta love these take one videos here. Okay, then a long-term look at inflation as measured by commodities, the CRB index. This has been going up. It's fallen back recently now, but we're above an advancing moving average. So commodities are going up. Then we look at inflation versus deflation, and this still continues to go down. So this is actually a little bit more inflation friendly, where the CRB index longer term is looking a little more inflationary. And we look at a daily chart of the CRB index. It's in an uptrend. And you're going to see later on that for a long time now, stocks have been outperforming commodities. We're starting to see that trend change now. And it's looking like commodities are beginning to outperform stocks. We'll just watch that as it unfolds. And that's another clue that we look at. And that's why, one of the reasons why I do this particular video. Then we look at the Baltic Dry Index, which has been going down and it's still in a downtrend. When this goes up, that tends to be more inflationary. Well, it's starting to pick back up now. Then inflation expectations going back, this is a weekly chart, going back to the beginning of 2025, they've actually come down. And this kind of flies in the face of what the market's freaking out about right now. This is an actual ETF. And with this declining, that means that inflation is lessening a bit here, where in the latter part of 2024, it was actually increasing. All right, then we keep an eye on different commodities markets. And I don't trade these markets, I just look at them when I prepare this video just to keep a mind on what's happening in these different markets. Aluminum is actually going down and starting a downtrend. Then we look at some of the food areas like corn. It's in an uptrend, which could be inflationary. And we look at wheat, which is still in a downtrend, but it's been trying to go back up recently as well. We look at fertilizer, and this is long term. This goes all the way back to like 2003 or so. And you can see there's times when fertilizer goes up, and that can be inflationary. This was during the great financial crisis. Then we ran into some problems in 2013. This is the whole COVID crash. And then it's been coming down and it's been going sideways, but it has started to go back up lately. So we just want to keep an eye on this. This is a chart that I used to show a few years ago in the videos, and then I dropped it because the chart I was using got all messed up. And I was looking through some chart lists and I saw this, and it's looking a little more useful now. This is just lumber. And when it's going up, that tends to be inflationary. When it's going down, that's deflationary. Well, way back during the COVID crash, this is when folks were going to Lowe's and Home Depot and getting all that lumber for the home projects that they were doing because they couldn't go anywhere. And so we saw the price of lumber really going up. Then it fell. Then it started to go up again. We've leveled off over here, but we are in an uptrend right now. So this could also be inflationary. Oil is actually in a downtrend right now. We're dropping under 70. Now, there's a couple of different reasons to watch this. One is if oil companies are doing better and seeing more profits because oil's going up, that could be positive for the market. But there's also a geopolitical aspect to oil. There's a lot of tension in the Middle East and around the world. But so far, we've been in a downtrend with oil and actually dropping below 70. That's the lowest it's been in the recent past. We look at a gold to oil ratio where this has been going up, meaning gold has been outperforming oil. Well, gold got hit pretty hard this past week. And so that's why this ratio is just coming down a tiny bit, but still the longer term trend shows gold outperforming. And we look at a correlation between the 10-year yield, which has been coming down now overall. And then we look at the dash line, which is oil, which has been coming down. And we see that there's a pretty high correlation between the two. They're tending to go in the same direction at the same time, whether it's up or down. It's just lately it's been more or less down. Here's gas, which is still in a downtrend, but it's been really going back up and now pulling back. If we stay above these lines, this could generate an uptrend here pretty soon. Heating oil, which has been bouncing back up, but still in a downtrend. Natural gas, which is now in an uptrend, that could be inflationary. Diesel, which has been going up lately too. And if that continues to go up, that would be more inflationary. And now copper we use in a little different way. This is known as a barometer of the economy. And we're seeing a real improvement here. Now, even though there's concerns about the economy now, since the beginning of 2025, copper's been going up. So this market is anticipating the economy getting better going forward. And this is not quite in an uptrend. This blue line is a 50-period moving average, and it's just getting ready to cross the 200-period moving average. Now, I also have a 20-period moving average on here that moves a lot quicker, but that's more short to intermediate term, where the 50 to 200 is more long term. We look at a copper to gold ratio, and since gold's been getting hit, copper's been going up. We're seeing this bouncing back up, but the longer term relationship shows copper underperforming. And this is something we've been watching for years. This is a longer term look at the copper to gold ratio, and then plotted with the 2-year yield in green and the 10-year yield in red. Well, for periods of time, they tend to go in the same direction. And even though they're on different scales, they don't get all that far apart. Well, we've seen a real disconnect here and actually moving in opposite directions, pretty much going back to the beginning of 2022. And that relationship hasn't really changed. But we've been watching this, but it hasn't really led into anything all that significant, at least yet. Gold, which is in an uptrend and hit an all-time high here. And I just follow the gold ETF. I don't follow the futures contract, but over the last week, it's really been coming down. Silver's still in an uptrend, also pulling back recently. And then we look at the closing price for gold on top, the closing price for silver on the bottom, and we can see that there's a pretty high correlation between the price of gold and the price of silver. Then I look at a gold to silver ratio on top. This is when this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we plot the US dollar index to try to get some insight as to the relationship between precious metals and currencies. But this is still pretty much neutral. If we go really high, that means the correlation is strong. If we go really low, that means they're going in opposite directions. When we're right around the middle, that means that they're more or less neutral. The dollar, which had been coming back down, even though it's still in an uptrend here, this going up earlier on, a few months ago, this was putting some pressure on stocks. We saw the dollar really going up. Now, stocks were doing okay during periods of time, but this was causing some concern. Stocks like a weaker dollar. Well, it's been pulling back, and that was helping things for a while, but then we seem to have lost the momentum in some of the growth stocks. We look at the euro on top and then the US dollar index on the bottom, and these are mirror images of each other. And then we look at the Japanese yen and the euro and then the dollar all plotted together. Then I break them out. And the euro is still in a downtrend compared to the dollar. It was trying to bounce back up, but now it's dropping back down. The Japanese yen is in a downtrend, but it's been bouncing back up lately. And then the British pound is still in a downtrend compared to the dollar, but also bouncing up recently. Then we look at some other indexes. Yes, I do show this in the daily video quite often. This is the S&P 500, which is the bar chart. That's a weighted index. So the really big stocks have more of an impact. The red line is an equal weight version where all 503 stocks in the S&P are treated the same. When this line is underneath the bar chart, that means the broader S&P is underperforming the weighted version of the S&P. You can see going back to last fall, they were pretty much going in lockstep with each other. Well, now we've seen a bit of a disconnect as the red line is underneath the bar chart itself. We'll keep an eye on this to see if there's further weakness. Now, lately, we've been seeing the rest of the stocks in the S&P actually performing better than the weighted version of the S&P, which has more accounting for the big stocks. And if this red line comes back up, that would just show that that's continuing. And that could mean that things are getting more defensive. But if they're both going up, of course, that's positive. Then we look at a ratio between the equal weight version and the weighted version of the S&P. Well, this is going down. That means the equal weight is underperforming. It's been chopping around a bit so far in 2025. This is where we're starting to see a change, at least with a moving average crossover here. When this blue line crosses below the red line, that's called a death cross. Now, for all of 2023 and into through 2024, stocks have been outperforming commodities, but we're possibly seeing a change here. Now, we could go back up and make this not last very long. We saw this coming down in late 2023, and it did recover. So it doesn't necessarily mean things are going to change, but if this crosses over and continues to fall, that could suggest that things are getting more defensive and inflationary. And then this is an inverse of that same thing where commodities had been underperforming. Now they're starting to show some strength. We're also seeing a golden cross here. That's when the blue line crosses above the red line. We look at the NASDAQ 100 and compare it to the S&P 500, still in an uptrend, but seeing some weakness now in both indexes, and that's bringing this ratio down. And the S&P 100 is actually in a downtrend compared to the S&P 500. Longer term, it's holding up, but here on the daily charts, the bigger stocks that make up the S&P are actually underperforming. The NASDAQ, which is mainly a lot of tech, and that's a broad market measure, it had been outperforming the S&P, but lately pulling back and falling underneath the 200-day moving average with this ratio. Little bit of a concern there. The NASDAQ 100 on a trending basis is still underperforming the rest of the NASDAQ. Lately, we've been seeing the NASDAQ 100 holding up better and a little bit more weakness in the NASDAQ itself. And then we look at the mega cap growth with the equal weight version here. And notice how we came all the way down to this 200-day moving average and then bounced up in Friday's session. If we could continue to bounce back up, that means the mega caps might be showing some strength again. If we come down and fall below this 200-day moving average, that means the mega caps may continue to lag. Then small caps, just this, that's the red line here. It's a small cap to S&P ratio. It just continues to go down. Even when the S&P is in trouble, this ratio still goes down. The blue line is the S&P itself. We look at another ratio showing how small caps are underperforming the S&P. Even for a lot of 2025, the S&P was going sideways, and then lately it's turned a little more negative in the short and intermediate term. Well, small caps are turning even more negative. And the robotics and AI ETF, yeah, this is supposed to be all the rage. According to this, we're coming down to the lower end of the rainbow here, not showing a lot of strength. But even though independently, the robotics and AI ETF has not been doing all that great, it's holding up better when we compare it to the tech sector, which has also been under pressure lately. Now, I have a new ETF here. This is AI and tech together, a big part of growth. Now, this has been stronger lately. I don't have a ratio comparing it to the tech sector. I'm just looking at this ETF by itself. But lately, it's been coming down. We dropped below the 50-day moving average, but we haven't come down to the 200-day moving average yet. And I'll keep an eye on this. Maybe I'll do another ratio with this ETF compared to the tech sector. Mega cap growth, this is where the real strength comes from in the market. It's been falling back, but we're still seeing the blue line well above the red line. And the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, still in an uptrend, but not showing an awful lot of strength recently. Low volatility stocks, these are more defensive. Now, there's money managers out there that manage ETFs or mutual funds or just money for their clients, and they make an agreement, whether it's a prospectus for a mutual fund or some kind of a mandate within the ETF that says, okay, we have to stay invested all the time. We can't go into cash like we as individual investors can. And so they have to find somewhere to put their money. And with this going up the way it has been, now it climbed through 2024 as the S&P was climbing, but this going up might be a little bit of a concern because it's showing that the market could be getting more defensive. Now, this is just looking at this index or this ETF by itself. When you compare it to the S&P, it's been really underperforming, but lately it's been bouncing back up. And this is part of the defensive posturing that I've been talking about in the daily videos. Then we look at the S&P against other stocks. This is an advanced decline line. We had dropped below the moving average with the NYSE common stock, but Friday had an up day and we're coming back up to the moving average. And now, even with the weakness that the S&P has been under, the advanced decline line's been holding up above its moving average. Now, as I said, it's not so much from the mega caps that's driving this. It could be the rest of the stocks because the S&P is a pretty balanced index. It's 503 stocks. There's value in there. There's growth in there. There's some areas that go up as other areas go down. And so this is holding up better. The mid caps did fall below the moving average, but came back up in Friday's session. And we're still seeing more weakness, even with a little bounce on Friday with the small caps. Then traditional Dow theory looks at the Dow and the transports. And I just eyeball this where we're well off the highs with the Dow, but it's actually still positive year to date. And it had a pretty good day on Friday and a pretty good week. Well, we compared that to the transports, which pretty much continue to go sideways. And utilities, which were really strong throughout a lot of 2024, they've started to chop sideways as well. We look at a ratio between the Dow and the transports. Going back to the summer of 2023, this ratio has pretty much been going up. That means the Dow is outperforming the transports. And you can probably see why here. We've just been treading sideways with the transports. We look at a correlation between the S&P and the Dow transports here, and we can see that there's a pretty strong correlation. We're up in this red area. As the S&P has been under pressure, transports are also under pressure. But when the S&P has been going up, we haven't really seen big corresponding relationships in the same direction to the positive side with this particular study. And this compares the transports with the S&P going down. This shows how transports have been underperforming. The Wilshire, which is a broad market measure, holding up fairly well lately, but then it fell below its 50-day moving average. And then another total US stock ETF. This is a broad market measure, had been holding up above its 50-day moving average, but then recently dropped below it. So yeah, we're seeing some weakness coming into the market here. Now, instead of using the Dow and the transports, we swapped those out for the S&P and the Nasdaq, and this has been coming down with the S&P, and the Nasdaq has also been coming down lately as well. Then we break it down a little bit more to see if we get some additional insight. Instead of using the weighted version of the S&P, we use the equal weight version of the S&P. And this did not come back. Just a week before last, we set two all-time highs with the S&P weighted index. That was not confirmed by the equal weighted version. Now, there's also the QQQs and then an equal weight version of the QQQs, which means all the stocks are treated the same. This did recently set an all-time high that was not confirmed by the equal weight. And then both have been, well, actually, the equal weight has been actually coming down more, where the equal weight version has been holding up a little bit better. The FANG index, another mega cap type index, still in an uptrend, but falling below its 50-day moving average. And we were watching this longer term trend line. We broke below it, and now we're starting to go further below it now. Semiconductors, another area that I've been keeping an eye on. There's another chart that I look at too. We're dropping below the rainbow now. Now, the semiconductors are a huge part of tech, and tech is a huge part of the NASDAQ 100 and the NASDAQ, and it's also a big part of the S&P. And so to see this weakness is another reason why we've been under pressure lately with the S&P, either going down or not going up very much. ARC, it's in an uptrend, but man, it got hammered this past week. And all world's stocks where you take out US stocks, these are in an uptrend right now. But this is interesting. The next chart, we look at a ratio between US and then all the stocks in the rest of the world. We're coming down to this 200-day moving average. And we've been here before and we were able to bounce up off of that. If we break below this, that could turn things more negative. Or maybe we've hit a bottom and we're going to be able to come up out of this, meaning US stocks will start to outperform world stocks. Now, that hasn't happened yet. It held up on Friday, but we have to see more follow through with this. Small caps, which have been under pressure, and then tech going into the latter part of 2024 into 2025, we're just chopping sideways with this ratio. Then we look at a monthly chart of the US stocks and then global stocks, and it's been coming down, but we're still above this advancing moving average longer term. The problem is the momentum oscillator, the PPO, it's starting to roll over. And that just shows this loss of momentum longer term that we had been seeing. Then we look at bonds. This is the 7 to 10-year bond price where it's been going up. And then when this goes up, interest rates go down. a total bond ETF, which has been showing some strength lately, and that's encouraging. If bond prices go up, that means interest rates are going down. And then corporate bonds, high yield corporate bonds, these are junk bonds. They're still holding up and doing quite well. And then these are corporate bonds, more conservative. We're starting to see a death cross here. And there's another index I'll show just in a moment, also suggesting that we're turning more negative there. Then we look at how bonds have been underperforming stocks, but this has been bouncing up lately, but we still haven't gone above the 200-day moving average yet. A long-term chart of a stock to bond ratio still going up, both with the blue line, even though we're pulling back recently with this ratio. Then we look at a stock to bond correlation, and they're actually having a pretty strong tendency to go in opposite directions right now. So if one's going up, the other one's going down. If the other one's going down, the other one's going up. We're still in a downtrend when we look at world bonds, though. And then I have some Fibonacci studies. I include these every week just in case there's a change. We're in between these Fib retracement levels here on the 10-year yield. And we're in between these retracement areas on the 30-year yield. And then we look at a long-term look at the 10-year yield, which has been going up into a higher range after it's been 40 years setting a series of lower highs and lower lows. This is a daily chart where we've been falling back down lately. So interest rates have been coming back down. This is a weekly chart where we see where US and UK rates are coming down, German rates coming down after they have been going up. But lately, what I've been pointing out with this chart is the red area. This is the 10-year yield in Japan. And this going up caused a lot of problems last summer. We're wondering if this continues to go up, is that going to cause more problems? Then we look at a different number of ratios looking at stocks versus bonds. This is the S&P 500 with short-term bonds based on price. And we're coming back down into the rainbow. Then a broad market measure, the S&P 1500 with short-term bonds, also coming back down into the rainbow. So it's been getting hit lately. If this drops all the way down and goes below the rainbow, that's going to turn things much more negative. See how they reacted back in 2022 when we were in the cyclical bear market? And then a broad market measure with further out bonds, 3 to 7 years, also coming back into the rainbow. The tech sector falling below the rainbow here when compared to 3 to 7 year bonds. Now, we've fallen below this before and we were able to bounce back up anyway. But if this continues to fall and the lines begin to roll over, yeah, that's going to turn things more negative. This is where we're seeing a death cross with the Dow Jones Corporate Bond Index. There's corporate bonds and there's government bonds. And even though this has been bouncing back up lately, these moving averages are starting to suggest a downtrend. Now, if we stay above both of these lines, then this death cross won't last for very long, and it'll turn back into a golden cross. Then we look at the S&P 500 and 10-year yield. This is starting to show a downtrend where when the blue line's above the red line, that means stocks are outperforming interest rates. Lately, we've been seeing a change in that. Junk bonds, which still continue to do quite well, just coming off of setting a recent all-time high. And then we've been pulling back a little bit, but then going back up with this ratio when we look at junk bonds versus more conservative government bonds. And then this has been going up too. This is another ratio of junk bonds or riskier bonds to more conservative bonds like government bonds. This has been coming down as interest rates have been coming down. Is if the economy is getting ready to do some changing, folks are getting out of the riskier bonds because they can lock in a higher yield in a more conservative bond or government bond. And then we look at how bonds have been underperforming stocks, but bouncing back up, but not enough to change the longer term trend. Then we look at a monthly price of the 30-year bond, which is in a downtrend now. And then we do a ratio between the long-term bond and commodities. This is starting to roll over now. So it just means commodities on a shorter term basis are outperforming the long-term price of bonds. Then I look at the volatility of bonds on top. That's measured by the MOVE index. This has been going up a little bit, but the moving average is still going down. I keep a real close watch on the volatility of stocks as measured by the VIX. That's been going up. We actually got above 20 with the VIX earlier in the week, and then in Friday's session, we dropped down back below 20. When we get to 20 or above, that's when things tend to turn much more negative. Then this is a chart that I just found that at the beginning of this video, I looked at the PE ratios just for the S&P itself, and then a little bit of the forward look for the mid caps and small caps. This breaks down the current PE ratio of all 11 sectors in the S&P. And then it shows you how they rank here. And this just gives you an idea. We use that same 10, 15, 20 scale. So down at the bottom where energy is more fairly priced, and all the way at the top, we still have tech over 26. So this is when people say the market's expensive, especially with growth, this is kind of what they're referring to here. And now I break it out and just look at sectors where the materials are in a downtrend right now and also underperforming and going sideways lately when we compare to the S&P. Communication, a growth area, still in an uptrend, but came down to its 50-day moving average. If we can bounce up off of this, that might bring some more strength back into the market. And we're also still outperforming when we do a ratio with the S&P. It's one of the better looking ratios that we see right now. Energy, which has just been chopping along sideways. Technically, it's in a downtrend because the blue line's below the red line. And the energy sector bouncing back up a little bit here, but still in a downtrend when we compare it to the S&P. Financials doing pretty good, at least on a shorter term basis. This is still in an uptrend and well above its 50-day moving average, up over 2% on Friday. Not quite back to a new high here. And it's showing an improvement when compared to the S&P. We want the financial sector to do better or to do good because it just fell apart back in late 2007 into 2008 when we went into the great financial crisis. This going up is more positive for the market. Industrials still dealing with their 50-day moving average, but still in an uptrend. And in a downtrend, though, when we compare it to the S&P, even though it's been bouncing back up lately. And the tech sector, this is like the monster growth area. And we just look at this sector all by itself first. We're falling below the 200-day moving average. Can we get back above that? We've fallen below before, and we're able to bounce up out of this. So we'll be watching this, even though it's still in an uptrend longer term over the last couple of years. And then we look at a ratio between the tech sector and the S&P, and tech's been under pressure lately. Going back to about November, even into October, we've been chopping sideways with this ratio, and it's in a downtrend with this ratio as well. We want to go back to what we saw last spring and summer, where the tech sector was outperforming the S&P. We're not seeing that yet. Staples, another defensive area. Even though this has been going back up, we're getting really close to a death cross here with this sector. And it's been underperforming the S&P when we look at staples, but lately it's been bouncing back up. And this is another defensive move that we're watching to see if there's going to be more follow through, that the market might be getting ready to turn more defensive. And then real estate, which is still in an uptrend, and it likes when interest rates are going down, but really underperforming when we compare it to the S&P, even though lately it's been bouncing back up. Utilities, also typically seen as a defensive area, but you could put it into the growth category because of EV and AI and all this electricity that's going to be needed. It's in an uptrend, even though it's been pulling back, but it's in a downtrend when we compare it to the S&P, even though it's been popping back up lately. And then we look at an S&P to utilities ratio, been chopping all around so far in 2025. When this is going up, that means the S&P is outperforming. When this is going down, that means the S&P is underperforming. No real conviction right now. Healthcare, another defensive area. Have to have healthcare no matter what's happening with the economy. We're in a downtrend when we look at the sector all by itself, even though it's coming back up and been holding above its 200-day moving average, but really underperforming when we compare it to the S&P, even though it's been going sideways to showing some improvement. This would be more defensive as well. Discretionary, going back to the end of the day or end of the world day in early August, this sector had been just doing great. Well, we got into the early part of 2025 and this has been pulling back. A lot of this is attributed to weakness in Tesla. And it's still in an uptrend when compared to the S&P, but really showing some recent weakness. Semiconductors, a huge part of the tech sector, below the 50 period moving average and actually in a downtrend when we look at the SOX index. But then we look at an ETF of semiconductors. This is holding up a bit better, but we just recently dropped below this rainbow. So that could be turning more negative as well. Then we do a ratio between the energy sector and tech. It's still showing that energy is underperforming, even though it's been bouncing back up. And then we look at growth stocks versus more conservative bonds. Going throughout most of 2024, growth stocks were outperforming, but lately they've been pulling back. If this continues to fall and we eventually see a death cross, that's going to suggest things are becoming more defensive. We've fallen down here before, but we were able to recoup from that. And then the tech sector to the 10-year yield, starting to see where the tech sector is underperforming. We're seeing a recent death cross here compared to the 10-year yield, but it's been pretty much going sideways since the beginning of 2025. This is an inverse of that same chart where it's starting to go in an uptrend, meaning that the 10-year yield is beginning to outperform the tech sector. That's could be a little more defensive there. And discretionary to staples, this had been doing really well, but now because of Tesla, really been pulling back. And this is an inverse where staples have been underperforming, but lately really starting to outperform. And then gold is to the S&P, not really much. We're just chopping sideways now. And gold to the dollar, where when this is going up, that means gold's outperforming, pulled back. Then it's starting to go up, even though gold did not have a good week. We saw this ratio come down just a little bit on Friday. Now, this is more encouraging, though. The NYSE composite, it's above its 50-day moving average and in a more solid uptrend, even though it's been chopping sideways for a lot of 2025. Now, this is another proxy that can be used to gauge the overall economy. There's some growth concerns out there, but you would not know it by this. These are high leverage loans. They're very risky. And we've been in a solid uptrend going back to the beginning of 2023. All stocks, which looks at US and international stocks, still in an uptrend, but pulling up down, actually fell below its 50-day moving average, but was able to recoup that on Friday. Emerging markets just trying to eke out an ever so slight uptrend here, but not quite there yet. Japan's just been chopping sideways, even though it dropped off a little bit later in the last week. The really small stocks still in an uptrend, but coming down and dealing with their 200-day moving average. And then we look at the S&P and home builders, still a strong tendency, even though it's getting weaker, of the relationship between the top chart and the bottom chart. When we really go down here, that's when we get a little bit more concerned. And Bitcoin just cannot stay above 100,000. Now it's coming down and testing its 200-day moving average at about the 78 to 84,000 range. And this is a long-term oscillator looking at world stocks. We're in an uptrend in China. Now, some of that could be attributed to a lot of government surplus and cutting interest rates and trying to re-stimulate the Chinese economy. Emerging markets are looking a little stronger, but possibly starting to roll over. We're flat in Europe, even though Europe's been doing quite well lately. And we're going up, but could be rolling over here in Japan, and we're actually starting to turn down in the US. And then an intermarket analysis chart going back to the beginning of 2025. Even though it's been declining lately, gold has been performing the best year to date, where, believe it or not, bonds are in second place, followed by stocks. That's the black line. Oil is the red line, and then the dollar, which is the green line. Then we look at some correlations. The S&P to the dollar, neutral right now. If we break above the blue line, that means they're going in the same direction. If we break below the red line, that means they're going in opposite directions. And the S&P to oil, seeing them going in the same basic direction, which lately has been down. And then the S&P to the 10-year yield going in the same direction right now. So if the 10-year yield's going down here, the S&P's been going down too, which is not what we normally see. When we see a stronger relationship between stocks and the 10-year yield, it's when they're going in opposite directions. One's going up while the other one's going down. And that's why I say that the relationship between stocks and interest rates have kind of settled down now. It was pretty strong here at the end of 2024, going into early 2025. Now that seems to be shifting a bit. Stocks to the 2-year yield, shorter term, also a tendency to go in the same direction. Then the tech sector to the 10-year yield, more of a stronger correlation to go in the same direction at the same time, which lately has been down. Then some long-term charts. This is a monthly chart of the NYSE. It's still looking positive here and above its moving average, but longer term, we're rolling over with the momentum oscillator, the Copic curve. Now, this is a monthly chart. We're going to click over into March here pretty soon. So this, in fact, it'll be for Monday's session. So this will see if we're seeing more weakness here. And a daily chart of the NYSE, which is holding up better. And so far in 2025, the record high percent index has been going up, even though it's fell back recently. This is holding up better, but not really showing a lot of conviction. Then a monthly chart of the S&P above the moving average, and then the PPO, a long-term price oscillator. This is actually starting to go down, showing a real slowdown of the upward momentum. And then the S&P on top, and then a correlation between the S&P stocks and commodities down here. This is longer term. We're rolling over here as commodities could be starting to outperform stocks. And then another monthly chart here looking at US stocks versus global stocks. Even though they're pulling back, we're still above an advancing moving average, and the long-term oscillator, the KST, is still going up. Now, again, this is going to click over into a new month, so we'll see if there's any drastic change with this momentum oscillator. Then at the end, I list all those things that are positive, and this is when the 50-period moving average is above the 200-period moving average. So when you look at growth and value by themselves, the dollar's still in an uptrend, CRB index, gold, silver, mega caps, the FANG index, even though ARK got hammered this past week, it's still in an uptrend. The low volatility ETF by itself, staples are in an uptrend, as are the Dow Jones Composite average. Now, there's one thing that got taken off this list, and that's corporate bonds based on price. But we're still in uptrends with total bonds, high yield bonds, investment grade bonds, and junk bonds. Tech sector is still in an uptrend, even though it's been getting hit lately. And high leverage loans are still looking pretty solid. The Dow, the NYSE Composite, and Wilshire are in uptrends, as is the NASDAQ and NASDAQ 100. Mid caps, small caps, even though they've been under a lot of pressure lately, they're still in longer term uptrends, as are the micro caps. All stocks, both stocks in the US and around the world, that's in an uptrend. Emerging markets, trying to eke out an uptrend there. And Bitcoin, it's been really falling back and dealing with its 200-day moving average, but it's still in an uptrend. Then at the end, this is when the 50-period moving average is below the 200. Copper still hasn't quite crossed above. The 50 has not gone above the 200-day moving average. And then the euro, the yen, the British pound, everything against the dollar are still in downtrends compared to the dollar. So the dollar's been outperforming. And then, depending on what part of the semiconductor area you look at, we are more negative now with the SOX index, but the ETF, it's still positive, but really showing some weakness lately. And the World Bond Index, that's a new addition to this list. These are world bonds based on price, as well as corporate bonds are now showing a downtrend. Thank you. I really hope you found this helpful. Have a great weekend, and I will talk to you in the next video.